couple of major events in the U.S. were the major focus last week and drove both stocks and the dollar index sharply higher. The so-called fiscal cliff agreement was finally reached, which initially sent the dollar lower on risk appetite. But the move then quickly reversed as the dollar rebounded. The much less dovish Federal Open Market Committee minutes then gave the dollar a strong boost against European majors, which was then followed by a solid employment report. In the end, while the S&P 500 was limited below the 1,474.51 resistance, the close at 1,466.47 was the highest since 2007. The Japanese yen remained the weakest currency last week. European majors were broadly lower against other major currencies, while commodity currencies outperformed following stocks. Technically, the upside momentum in yen crosses remained generally strong as persistent selling in the yen continued. Aussie dollar Japanese yen has indeed taken out an important resistance level at 90. More downside could be seen in European majors against the dollar in the near term, but the current move is viewed more as a correction only and the downside could possibly be limited. More upside is favored in commodity currencies against the dollar, but recent moves in US dollar, Canadian dollar and Australian dollar US dollar are also corrective looking, and thus we might see dollar bottoms against the Aussie and loonie in the near term. So overall, for near-term trade within 1 or 2 weeks, long Australian dollar Japanese yen should be considered for the 100 psychological level. But we'd be cautious on bottoming in the dollar. And should that happen, we'd prefer to switch from Australian dollar Japanese yen long to US dollar Japanese yen long. Late at night on January 1, the House passed the fiscal cliff bill by a 257 to 167 bipartisan vote, which was earlier passed by the Senate 89 to 8. The compromised deal was worked out by Vice President Biden and Senate Minority Leader McConnell. Based on the deal, tax would be the same for most Americans, while the tax rate would jump from 35% to 39.6% on families earning over $450,000 per annum, or over $400,000 for singles. The level was raised from Obama's threshold of $250,000. Nonetheless, it's somewhat addressed by an itemized tax deduction cut for singles making over $250,000 and families making over $300,000. Unemployment insurance would be extended for a year for up to 2 million people. Meanwhile, the issue of spending cuts was not addressed in the package. The focus will possibly turn to the so-called debt ceiling in the coming weeks. Republicans have already made it clear that they will press for dramatic spending cuts in exchange for raising the $16.4 trillion federal debt ceiling. Such a ceiling has already been hit, and it's estimated that the extraordinary measures for funding federal operations could only buy around 2 months' time for negotiations. House Speaker Boehner is insisting that any increase in the debt ceiling should be offset by equivalent spending cuts. Meanwhile, President Obama proposed that the president could unilaterally raise the limit unless being overridden by a 2/3 majority in Congress. The Treasury Secretary went even further and suggested eliminating the debt ceiling altogether. The Federal Open Market Committee minutes for the December meeting revealed that policymakers were split on the timing to end asset purchases, signaling the possibility of terminating the program by the end of 2013. As mentioned in the minutes, a few members expressed the view that ongoing asset purchases would likely be warranted until about the end of 2013, while a few others emphasized the need for considerable policy accommodation but did not state a specific time frame or total for purchases. Some even thought that the central bank should slow down or stop purchases well before the end of 2013, citing concerns about financial stability or the size of the balance sheet. Financial markets were disappointed by the minutes, with stocks and commodities losing ground while the US dollar extended gains. Economic data from the U.S. was generally positive, with the non-farm payroll report showed a 155,000 job growth in December versus consensus of 145,000, while November's figure was revised up from 100,000